Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, we'll be joined by our guest co-host, Kash Pashutin, CEO of First Avenue Investment Counsel. And later, our featured guest, Rishi Jaluria of RBC Capital Markets, will break down the Oracle earnings with us. And finally, of course, we want to hear from you on First Call. Call us with your questions on North American equities, and we'll have Kash answer as many of them as he can. Number 1-855-326-6266. We'll open the phone lines in about 30 minutes. You can always email us as well. First call at bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Empire is out with its latest results, and the Canadian grocer posting revenue in its latest quarter that topped consensus. There was also growth in same-store sales. Profit, however, came in below expectations. The owner of Sobeys, Farm Boy, and Freshco says the decline was due to higher expenses, including higher staffing costs, store upgrades, and growth initiatives. Canadian company Dollarama reported a 22% spike in revenue in its most recent quarter, beating expectations. The discount retailer also posted higher profit and same-store sales that exceeded estimates. The boost has led the company to increase its 2026 outlook for Canadian same-store sales. Suncor Energy has unveiled its plans for next year, and it includes growth targets for production as well as an increase in share buybacks. The energy company now expects total production of up to 870,000 barrels of oil a day. That's a growth of more than 100,000 barrels over 2023 and surpassing targets outlined last year. Suncor also increased its share buyback by 10%. And now our top line story. The Bank of Canada held its interest rates steady yesterday, moving back to the sidelines for what financial markets expect to be an extended pause. For more now, let's bring in our guest co-host, Kash Pashutin, CEO of First Avenue Investment Counsel. Kash, thanks as always for joining us.
Thanks, Roger.
We kind of expected this, no real surprises. Were there any surprises beyond that number not moving?
No, like you said, it was priced in and really the view of the masses. The question is, how much emphasis are we placing on this, or is Bank of Canada placing on some of the data that they're seeing in terms of how they look forward? I do believe, Roger, we're playing a very dangerous game in terms of trying to be very cute with managing inflation and ignoring the fact that the consumer is in a really challenging spot here in Canada. And I guess we'll talk a little bit more about how this can all play out, but no real surprises. But I think a very critical time for Bank of Canada in terms of the good or the bad that they can do to the economy as we move forward.
What is your worry that this may do then?
Well, look, I think it doesn't take much investigating when you look around, but the Canadian consumer is strapped, and it's not just sort of one segment of society or economic or earning potential consumer. Really, all the way up the chain, you're seeing that the cost of living and really the consumer's ability to spend, I should say, is quite challenged. So the idea of potentially raising rates to me is absolutely reckless. I think it is nuts for Canada to be considering raising rates, given how fragile the economy is. And I think it's premature to say that they're going to do that. As we know, there is a developing narrative that this might happen as we get into later 2026. But I think that's suicide for the Canadian economy.
Excuse me. And after hearing the comments yesterday, does it sound like there had been talk that it might happen? Now it feels like it's backed off a little bit. Does it feel like that to you, that we might not see a rate hike?
Yeah. Look, we do feel better with some of the language yesterday, but I would have liked to see, and I know that it wasn't surprised that rates were held, but I think that the economy and the consumer can use a rate cut here without the risk of inflation peeking its head out again. But again, I don't work for Bank of Canada. I'm just really looking at what can we do to prosper and what can we do for the Canadian economy to grow. So our view is that holding rates was a bit premature, and I think we believe that a rate cut would have helped the consumer and just overall sentiment going into next year. You have a variety of household carrying charges from mortgages to other variable loans that could use the help. And I actually think by cutting a rate quarter point here, you would have actually, in fact, de-risked some of the exposure that the consumer has as we go into next year. But again, I don't work for Bank of Canada, but this is going to be a big thing as we go into 2026, because if Bank of Canada decides to take what they view as being cautious or conservative to not have inflation peek its head out again, I actually think it could work against us the other way, because the consumer is really month to month in many cases.
What kind of a factor is the dollar in all this?
Yeah, so look, I mean, the what history has shown us is that historically, when you cut interest rates, it puts downside pressure on your currency, so your currency gets weaker. But the point that we all know as it pertains to currency is that it's always a relative discussion. So yes, cutting rates reduces or weakens your currency, but it's always relative to what. So we always talk about the Canadian dollar versus the U.S. dollar. The U.S., as we know, has been much more vocal about rate cuts. As we get into 2026, we'll see what happens with the Fed chair, if there's a change there or not. If there is, which we believe there will be, the rate cut narrative we think is going to become stronger. So, Roger, we could likely, or there's a probability that we're going to see an environment in 2026 where the U.S. is cutting rates and Canada is holding rates. And if that plays out, from that input perspective, the Canadian dollar should get stronger. Now, there's obviously other inputs that play into the U.S. dollar, Canadian dollar exchange rate relationship, but interest rates are a big one. And as it stands now, based on that relationship, the Canadian dollar looks like it will get stronger as we embark on 26.
And bringing Ottawa in, we saw stimulus spending and promises for government efficiency. Do you expect to see more of that to help this economy, or does Ottawa have the money or have the ability to do it?
Look, they absolutely have the ability to do it. And I think that we're seeing some early positive signs that there's an awareness and a propensity to do that. Historically, the challenge with government has sometimes been that they don't see the issues from a consumer or voter perspective. But I also think the fact that they're talking about it is certainly a positive first step. But and even rolling out programs, I think these are all positives. But really, it's going to come down to once something is talked about, once something is approved, then how quickly do those dollars actually make it into the system, and how quickly does that stimulus program, whether it's building more homes or infrastructure jobs or whatever it may be, how quickly does that start to work itself in the system? So 26 is going to be an important year in terms of seeing these government promises go from promises to actually the dollars working in the system. And absolutely, I think they have the ability to do it. And I believe that the current government is aware and wants to do it. And so we're all hoping for Canada's good that it goes from promises to actual action with dollars in the system. Okay. Government historically, we know, has been bureaucratic. Things have moved slowly. But if the Canadian government here can get from promise to action, I think there's a lot of upside for the Canadian economy.
All right, we're going to have to leave it there for now, but we're going to be talking again in a couple of minutes. Up next, though, we're going to take a look at the markets before the bell. Let's see how things are shaping up on the markets. We'll start with the U.S. futures. Now, the Fed rate cut expected, but a likelihood of limited future cuts in the short term. And then the Oracle earnings are weighing on the markets. So you can see the Dow about a wash right now, but the Nasdaq right now is off by about a half a point. S&P 500 off by 0.3. And let's see what Oracle is doing right now in pre-market. You can see it's down 13%. That's going to drag down the NASDAQ for the day if it continues on into the day. And moving over to the major Asian markets, all of them in the red, finishing the day. That Fed rate cut was welcome, but still cautious sentiment, as you can see by those numbers there, especially the Nikkei. It's always a little volatile, off by 0.9. Hang Seng almost a wash, and the CSI 300 down by 0.86%. And heading to Europe, some modest sector rotation, overall cautious tone. You can see, though, some green there. The FTSE pretty much neutral, but the CAC 40 up by almost a half, and the German DAX up by 0.22. And the TSX finished the day record territory, a record close, 31,490, up by almost 0.8%. That in the wake of the BOC holding steady and the Fed cutting a quarter point. Tech, banks, and miners leading the way. So who were the movers yesterday? Lightspeed up by almost 6.9%. G Mining more than 6%. Going the other way, Capital Power down by 4.7%. Bombardier off by almost 6%. Taking a look at the metals now, you can see gold trading well above the $4,200 mark. It's up again 0.33%. Silver as well continues into uncharted territory. It's at $62.58, up 2.5%. Copper also up, facing record numbers as well. It's up 1.23%. Taking a look at oil, you can see yesterday the downward trend continues over oversupply concerns and also the U.S. seizing that shadow tanker from Venezuela. It's causing ripples, but not much more for now. May have it going the other way, but Western Canadian Select off yesterday. And WTI, what's it doing right now? Let's have a look here. It is down as well, below $58 a barrel, off by more than 1.1%. Well, there's no denying AI is transforming the global economy, but even the biggest believers need to be asking themselves, what could go wrong? For more, we're back with Cash Pashutin of First Avenue Investment Counsel. Cash, what could go wrong? Well, thanks for sticking around, joining us. What are your concerns with it?
Well, look, I think the AI discussion is obviously front and center, and rightfully so, for everybody, whether you're an investor or not. I think that it's important to look at history and see how, when we have transformative change, how that journey goes. And I would argue that the transformative change that AI is going to bring may be unlike anything else we've ever seen. Maybe the internet is probably the closest. But the point is that when we look at past journeys of such breakthrough or transformative technologies or change in how we live our lives and how we go to work and what we do, it is exactly that. It's a journey. And so there's multiple stages to that journey. And from an investment perspective, Roger, those stages each have some real winners and they have some real losers. And where it becomes dangerous is that because it's developing and it's developing fast, those losers are not 10% declines, sometimes not 20% declines. They can be 80% declines or 100% declines. And so we're in the really the first stage here of AI. And as we, there's a race to who's going to be the leader in the space. But the fact is, there isn't room for everybody that's in the game today to be there for stage two. So one of the things that I would sort of put out there for investors to be thinking about is, what if the bet that I have isn't going to be the winner? And obviously now it's becoming a little more clear as we think about what Google's doing and what OpenAI and what some of the other players are doing. But remember that losing in this type of journey doesn't mean a haircut. It can mean a serious decline. And as we go through this journey, there's going to be peripheral considerations and implications as well. And I wouldn't say that they're negative. I would say that there are going to be significant implications, positive and negative. And so really, as an investor, if you're, depending on how you approach investing, for us, we approach investing by starting by managing the risks first and then seeing what opportunities are left. When you look at that, and just to give you an example, for example, of some of the peripheral risks and opportunities, you think about the usage of electricity. and what that's going to mean for electricity prices and what that's going to mean eventually for the consumer. Don't forget, from May of 24 to May of 25 in the US, electricity rates went up 6.5%, 7%. No one's really talking about that, and we're still in the early stages. So what does that mean for the future? Does that mean that consumers need to think about electricity costs being a much higher percentage of their overall monthly expense? And we know, why does that matter? We know that the consumer is 70% of economic growth in a developed nation, 70. So there's a ripple effect that needs to be considered. Now, the flip side of that is, okay, what are the opportunities? And so you think about the unfortunate side of AI and the corruption and the harm that it can also do. So you can imagine cybersecurity spend is going to go through the roof. So what businesses will benefit from that? So really, it's this idea of starting with the thesis of saying, okay, if I look at history and I look at transformative change, the first thing that is glaring and very obvious is that it's a journey and it's not a one-stage phenomena. And as you go through that journey, there's winners and there's losers, and the winners are big and the losers are big. And then also consider, what is the ripple effect, the peripheral sort of plot that plays out, and who are the winners and who are the losers there. I think many people get so fixated on what's the company and what are they doing, and that is appropriate consideration, but you should start more macro and really lay out your game plan and your map and then go micro, as opposed to starting micro, because your head's down and you're going to miss a lot of what's going on around you.
Now, and in this phase, then what are you looking for? What are some of the things that might be warning signs to you, and what are some of the things that you might say, oh, looks like they've got stuff together?
Yeah, so we've been investing for 25 years, and one thing that experience teaches you is have humility and make sure you remind yourself every day that you're not as smart as you think you are. And so really, what does that mean in the world of AI? I would say that we're spending a lot of time, our investment teams and on the public side are spending a lot of time on the AI, the infrastructure, and understanding it and researching it. But what I would say is that we're still early enough, Roger, that you can get great exposure to the prospects of AI just through broad market exposure. I know that sounds boring, but boring is not a bad thing when it comes to investing. So I would say that we're still early enough that if you just had broad market exposure through even an ETF, you're participating in the expansion and the boom that's going on with AI. And I think over the next year, we're going to get more clarity on stage 2 and stage 3. And then you start to get into the specific businesses. But the good news right now is you can be there, you could participate, and you can do that in a well risk-adjusted manner through broad market exposure.
Okay, we'll wrap it up there, Cash, but you're going to be back and talk about some of the companies on your radar. And of course, Cash, let me try that in English now. Cash Pashutin, First Avenue Investment Counsel, is with us today, and he'll be back in a second. We're talking Trican. Time now to see what's on the radar for Cash Pashutin of First Avenue Investment Counsel. And we'll start off with Trican. Cash. What are you liking about it right now?
So really, when you look at the market, Roger, we've had a couple of really good years here, as we know. And when you look at the historical average of what the market's done over the last 50 years, and you look at what the market's done the last 2 years, it's well above that average. So really, it's a time to be thinking about quality in the portfolio and maybe ratcheting down some of the volatility and going to some more boring names as we enter 2026. And Trican fits the bill well. I mean, look, you're talking about a business here that's the largest in the pressure pumper space, so fracking, and they're a leader in Canada in the cementing services space. So they got 25 active cementing crews representing a third of the national market share. So we like the business from a quality and size perspective. And we also like what they've been doing in terms of their balance sheet. So they retired 48% of their outstanding shares. They've been active, but very selective on the M&A front. They acquired Iron Horse Energy Services more recently. So overall, we're talking about a business that gives you exposure to the space, high quality, still active, and the M&A front. So there's some growth potential there. But again, it's really fitting the theme of turning up the quality as we enter 2026.
And I was just looking at it was up at around 15, 20 years ago. And now it's, what's the net? It's at $6 now. And you think it's got a lot of room then?
Yeah, it's one of those, you occasionally get an opportunity to buy stocks that are high quality, blue chip, well established, and not expensive. And Trican's in that space in terms of when we look at the overall portfolio.
All right. And the other one I want to talk about, McKesson. You don't hear about too many 200-year-old companies.
No, you don't. And it's sort of the theme today. Roger, is turn up the quality, get a little more defensive as you go into 2026. And McKesson, although in a very different space, in the pharma space, within that theme. So $100 billion market cap, 20-year operating history. So they've been around a long time. They're large. And they're really the largest of three drug distributors that collectively comprise of 90% of the U.S. pharmaceutical wholesale sales distributing. So they're very large. It's a very tight circle of players in that space. It's a sticky business. So no major retailer has switched drug distributors for over a decade. And it's also very much non-cyclical, the demand. So we know drugs are a need, they're not a want. So we like the space, we like how they fit into the space. And again, from a portfolio management perspective, going into 2026, the idea of turning up the quality, but still targeting growth is front and center. And McKesson is another name that fits that theme today.
And excuse me, health sector overall, are you liking what you're seeing with it?
Yeah, we like it. I mean, there's obviously a longer term narrative or story there, aging demographics, and the fact is people are going to need more drugs, not less drugs, as they get older, and everyone's getting older, and that segment of the population is significant. So it's really about how do you play the space and make sure that the business that you're in, there's different ways to play it. You have the pharma names that are really front and center in terms of producing drugs, in terms of more lifestyle, or I'll call it the Ozempics of the world. And then you have the McKessons of the world that they're on the other side of things. It's slower, it's more boring. They're not doing anything revolutionary, but that slow and boring is what makes it conservative.
One of the greatest companies nobody's ever heard of, right?
Exactly.
Okay, we'll leave it there, Cash, but still ahead. Oracle releasing its second quarter earnings last night. We'll unpack those numbers right after the break. And of course, our phone lines will be open for first call. You can reach us at 1-855-326-6266 or an email, firstcall@bellmedia.ca. Transcontinental logged lower profit and revenue in its fourth quarter, missing estimates. The Canadian packaging and printing company says retail services and printing sector experienced challenges in the quarter due partly to labor disruptions at Canada Post. Now, earlier this week, Transcontinental agreed to sell its packaging business to U.S.-based Pro Ampac Holdings for $2.2 billion. The move will allow it to focus on transforming its retail services and printing and publishing segments. Empire's out with its latest results, and the Canadian grocer posted revenue in its latest quarter that topped consensus. There was also growth in same-store sales. Profit, however, came in below expectations. The owner of Sobeys, Farm Boy, and Fresco says the decline was due to higher expenses, including higher staffing costs, store upgrades, and growth initiatives. Canadian company Dollarama reported a 22% spike in revenue in its most recent quarter, beating expectations. The discount retailer also posted higher profit and same-store sales that exceeded estimates. The boost has led the company to increase its 2026 outlook for Canadian same-store sales. And taking a look at U.S. futures, Dow is a wash right now. The NASDAQ looking down about a half point. That is on the Oracle earnings. NVIDIA also off in early pre-market trading as well. The S&P 500 also down 0.34% right now. Yeah, Oracle's down in the pre-market trading this morning, extending yesterday's losses after the firm reported disappointing second quarter earnings. Here to unpack the numbers is Rishi Jaluria, Software Managing Director for RBC Capital Markets. Rishi, thank you very much for joining us.
Thank you for having me.
What was the most concerning number for you on this?
Yeah, look, I don't think that there's actually one specific number, right? We can point to OCI, we can point to some of the top line metrics, but really, I think it's actually more of the qualitative that was the issue here, not the quantitative. And really, it comes down to, well, they have these large contracts, they have these large RPO numbers. There's this $300 billion deal with OpenAI. Now, how are you going to pay for this, right? And while the management definitely sounded confident and they talked about their ability to raise capital while still maintaining this investment grade rating, I think there's just greater skepticism. And heading into earnings, I think investors were looking for more color on exactly what were the plans, what were the alternative financing arrangements out there, right? Whether that's doing SPVs like you've seen Meta do, whether that's even working with sovereign wealth funds, right? You have to kind of think a little bit outside of the box. But I do believe there are still concerns over how is Oracle going to be able to meet this demand in the time frame that they've laid out, and is there a risk to those kind of numbers out to 2030?
Cash, you have a question?
Oh. There we go. Sorry. How do you... So when you look at the stock now, do you believe that that's priced in, or do you believe that there's still another leg to go down before we start to sort of see some of the good news start to play out?
Yeah, look, I think the stock is going to remain a little bit of a battleground stock and a little bit volatile, but candidly think the stock is probably generally where it should be trading given all the uncertainty. Now, if we start to get a higher level of certainty over the capital coming through, or we start to see, more positive headlines around OpenAI and their ability to continue growing into this sort of commitment number that they've laid out, I think that could help Oracle stock. But really, I think it comes down to, as these data centers come online, as that revenue materializes, and we actually start to see the margin impact of this, I think that certainty is what could get the stock to work. And on the flip side, I think if there's delays in anything, or you start to get any worrying headlines around OpenAI, obviously with Gemini 3 over the past couple of weeks, that's been dominating the headlines to more OpenAI exposed names. That could lead a little bit of downside. So it really feels like there's a good amount of upside and a good amount of downside, and that's why I'm remaining sector performer on the name, because I really think that it could go either way in a big way. But I think this is pretty balanced in terms of a risk reward trade-off.
And what could be some of the delays? What might lead to some issues for it?
Yeah, look, number one is going to be financing, right? That's probably the big one, and that's why there was a lot of focus on that question on the call. But lots of other things could happen. Supply constraints, right? Whether that's GPUs, and you saw that Oracle is selling their interest in Ampere, which is supposed to be on the chip designing side. Power constraints, you keep hearing that all around there. Liquid cooling is always an issue. Data center leasing. So there are a lot of things that can happen that can delay the timelines of these. But I think financing is going to be the big one that we're all looking for, and just going to be looking at the news and headlines around their ability to raise debt. What do the credit spreads look like, et cetera.
And do you think you think the appetite is out there to get involved with them when it comes to raising that debt?
I think there is, but given that you've seen this AI capex trade, especially on the OpenAI side of the equation, as you've seen that cool down over the past couple of weeks, I think it's going to come at a higher price, right? And I think that's showing up in the numbers is just a little bit of a higher cost of capital here than maybe would have been expected after they reported that big Q1 earnings report that sent the stock up 40% on the day. Obviously the stock's down by my math somewhere around 130, 140 billion dollars since before reporting that number. But yeah, I do think that they'll be able to meet these commitments. I think there is still demand for investing in AI capex projects, but I think the higher cost is just reflecting the lower levels of certainty relative to before.
So you still think there are good opportunities to be had here then?
I think there's good opportunities in the AI ecosystem. Candidly, I'm a big believer in AI. I'm a mega bull on this trend. I'm personally a big believer in buying Microsoft over Oracle, especially at these levels, because I think Microsoft has so many different ways it can benefit from AI throughout the stack, not just at the infrastructure layer, but developer, data, application, security, et cetera.
And what's giving you the confidence on that? Where are you seeing that? Why are you feeling so confident about it?
Yeah, look, I think maybe twofold. Number one, I feel very confident about AI as a mega trend. I live in San Francisco. I'm surrounded by this stuff day in, day out. I'm actually here in New York City right now attending the AI Summit. And the big thing is I'm just seeing a lot of this, accelerating interest in AI and really use cases evolving. And maybe 2026 could be the year where we start to see it move from proof of concept and pilot into production. As it pertains to Microsoft, I think there's two things I would point to. Number one is I am seeing a lot of innovation out of them, which, for a $4 trillion market cap company is truly impressive to see. I think the second thing is they're being very deliberate about where they invest their CapEx dollars, where they put their time and attention, rather than focusing purely on revenue growth, right? They want to focus on where's there the durability of those benefits, not just focusing purely on training. And that's where I feel a lot more confidence over the durability of Microsoft's growth over the next 5, 10, 15 years. And I think we have to think in those timeframes, because AI is really a decades-long trend ahead of us. This is not just, the past 3 years that we've seen.
Okay, we'll have to leave it there, but Rishi, thanks very much for joining us.
Thank you.
Rishi Jaluria is a software managing director for RBC Capital Markets. Still ahead, yesterday, U.S. forces intercepted and seized a sanctioned oil tanker off the coast of Venezuela. We'll have more on that after this. And our phone lines are open. Cash is taking your questions on North American equities. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. U.S. forces intercepted and seized a sanctioned oil tanker off the coast of Venezuela. A senior Trump administration official referred to the ship as a stateless vessel that was last docked in Venezuela. U.S. action may make it much harder for Venezuela to export its crude, as other shippers are now likely to be more reluctant to load its cargoes. Bloomberg energy reporter Steven Stafczynski has more.
This is mostly due to their expectation that it was actually going to bring the oil to Cuba. Now, of course, the Trump administration did say that this is already a sanctioned vessel. They're trying to ratchet up pressure on Venezuela. And so they did this, they sort of really upped the pressure on that government and also the dark trade in general by seizing it. This was a surprise move. A lot in the market weren't expecting the Trump administration to do this, and this does show more pressure on the government for Venezuela. Now, of course, if they were going to deliver this crude to Cuba or not, that's a big question. This is a very large crude carrier. Trump was correct. It is big, 2 million barrels of oil, and it's abnormal to send carriers this large to Cuba. So where was its actual destination? It's still unclear. Was it actually going to China? But either way, the Trump administration did decide to do this, saying that because the ship was already sanctioned, we have the authority to board it and take it, as you see with these pretty striking images that were posted on social media.
2 million barrels. 2 million barrels. Yeah, that is a sizable tanker. What does this mean for the oil market, Stephen, then? I'm looking at Brent prices a little softer in the session today.
So this is the thing. If this sort of thing were to happen, let's say 2 years ago when the oil market were tighter, I think you would have seen a pretty large spike in Brent and WTI prices. But we're in a time when it's really frothy. We're entering a glut period. Now, Venezuela is a pretty sizable exporter of oil, despite the sanctions. I think they're shipping about 500,000 barrels a day, a lot of that going to China and elsewhere. But through dark fleet vessels, but that is still barrels on the market that, while they are sanctioned, They're able to find their way there, and the U.S. hasn't really taken any cracking down measures, which is why taking this ship would have an impact theoretically on the flows, because will ships now want to dock at Venezuela? Even if you're a dark vessel, are you worried about getting taken by the U.S. government? Are you worried about getting boarded? So while this is something that does tighten the amount of output from the country potentially, the market has a lot of capacity to replace it. China has other places to go. We're in a time when U.S. output is very strong. OPEC Plus has been increasing output over the last most of this last year. And demand in China actually hasn't really grown as much as some in the market had been expecting for a few years back. So you are entering a period which the IEA calls quite a large glut in 2026. So prices have been, they rose a little bit today, but they're down a bit and they are weaker.
And that was Bloomberg's Stephen Stepczynski. Well, Canadians are feeling the pinch this season as experts urge smarter spending while inflation holds near 2%. CTV's Annie Bergeron-Oliver has more.
The malls may be busy, but this year many Canadians are focused less on presents and more on presents.
Me and all my friends make gifts for each other, and I feel like that makes it so much more lasting, and it's not like a cost worry thing in the holidays.
This holiday season, economic anxiety is high. According to a new Nanos report, 42% of people rank grocery prices as their top financial concern. 17% say their biggest concern is personal debt. 16% housing costs, 8% job security, and just 8% say they have no financial concerns.
It doesn't matter how you cut it. The fact of the matter is 9 out of every 10 Canadians are feeling the economic squeeze in terms of the rising cost of housing, the rising cost of groceries, worried about personal debt, or even just worried about job security.
The financial stress being tied to uncertainty around tariffs and the high cost of living.
Recently, I've been trying not to go to the grocery store as much, but every time I go, I'll only buy the essentials, maybe 10 items, and I end up spending $100. It's insane.
And for those wishing for prices to come down, the Bank of Canada says that would actually be bad news.
If we were to try to push the whole price level down, that would cause a severe recession in Canada. Nobody wants that.
So what can Canadians do to help their financial future? Experts say try tracking where money is coming in and going out.
When you do this, you kind of figure out what you're really spending money on and what's important. And again, a lot of people, this is challenging. This is the whole budgeting, which if behind every good financial plan, there's a solid budget.
While the Bank of Canada expects inflation to hover around 2% next year, many experts believe that food prices will increase between 4 and 6%.
And that was CTV's Annie Bergeron-Oliver. Still ahead, we'll take a look at some notable analyst calls, including a downgrade on Alcon, the Swiss-American pharmaceutical and medical device company. That's ahead. Let's take a look at some of the notable analyst calls and recommendations. First up, Alcon, the Swiss eye care specialist, got its first bearish mark from analysts since August after Bank of America double downgraded the stock, warning that a slower rollout of its new eye surgery machines will pressure profit growth. Julien Odor lowered his rating to underperform from buy and is now the most pessimistic among analysts tracked by Bloomberg. He also slashed his 12-month price target to 60 Swiss francs, slightly below current levels. Why installations for the Unity system used for vitreoretinal and cataract surgery are tracking below the bank's expectations, he said. Analysts are still overwhelmingly positive on the stock and now has 24 buy recommendations among analysts tracked by Bloomberg, 8 holds and 1 sell equivalent. Sticking with healthcare, Lucid Capital analyst Elmer Piros initiated coverage of Neuron Pharma with a buy rating and 73 Swiss francs as a price target. Neuron is an Italian pharma company developing a first-in-class drug, evenamide, for treatment-resistant schizophrenia, and it sees blockbuster potential for the drug. Citi analyst Joanne Wench raised the firm's price target on Johnson & Johnson to $230 from $215 and keeping a buy rating on the shares. The firm adjusted ratings and targets in the medical technology sector as part of its 2026 outlook. Citi believes the S&P Equipment and Supplies Index remains undervalued and underappreciated. Now let's bring in our co-host, Kash Pashutin of First Avenue Investment Council. Cash, you like the medical field? We were talking about this. Some good opportunities, do you feel, when you see those things? Oh, do we have Cash?
AI.
There we go.
Yep. Yeah. Roger, it feels like as fast as the AI space is moving, the pharma space is moving as fast in its own way. You know, you had Ozempic, and now it's like, let's do the next drug and the next drug. And soon it's like you take a pill and you lose half your body weight in 24 hours. So look, I think it's in the short term, some of this innovation is going to be very exciting, and it feels like the consumer is quite receptive to it. Our concern is, what does this mean in terms of the consequences and potential litigation risks that come out of the side effects of taking these drugs? And we don't know, you know, to be frank, we don't know if 2 years from now we find that Ozempic created caused some sort of cancer, or the new drug that's coming out from Eli Lilly, for example, that promises that you lose body weight even faster. What's going to be the fallout of that, and what is the liability or the exposure that these drug companies have? And maybe the answer is nothing. But that's really, from our perspective, some of the main items on our mind as we're thinking about the go forward here on some of this innovation.
Okay, we'll leave it there. But when we come back, Cash, we're going to be taking your questions on First Call, so stick around. All right, let's get to the phones for First Call. And Anita from Markham, what's your question?
Good morning. Thank you for taking my call. My question is on Mullen Group. I'm thinking of selling my CN and CP and buying either Mullen Group or TFI. Your thoughts, please. And or should I stay away from transportation completely? Your thoughts, please. Thank you so much.
Thanks, Anita. Look, we like Mullen Group in the space, and so some of the things that we think make Mullen Group a little more compelling, Anita, is, well, first and foremost, you know, you asked, do we stay away from transportation? The short answer in our view is no, but you want to be diversified. You want to make sure that they're diversified in how they're operating this logistics business. And Mullen is not only amongst the largest, but they're amongst the most diversified. So they're in all sorts of different sectors and industries. So that is unique and interesting. But in terms of the business itself, look, I think you're getting a meat and potatoes business here. What I mean by that is boring, but boring is good. Strong free cash flow. The big question with Mullen Group is where does growth come from? And they are already large. They are already diversified. So what these guys are going to be focusing on is M&A, but there's not many big players that they can acquire. So it's going to be a lot of brick by brick M&A. And what I mean by that is smaller businesses that they could acquire and roll up. The good and the bad of that, the positive is they could probably buy it at great valuations. Often small business owners are not as sophisticated or demand the same premium as if you're selling a big publicly traded business. But the negative is that because they're small and Mullen is big, it's going to take several of those acquisitions to actually move the needle. So overall, we like it. It's diversified. It's a great way to have exposure to the space. I would just add an asterisk to it to say that there is a bit of a question mark about future growth, but you are buying a large, diversified, stable business. And I think that future growth comes over time through small brick by brick M&A.
Okay. Let's move on to an email from Jim. It says, good morning, gentlemen. Cash, what should I be doing with the cash in my self-directed account that is collecting zero interest? Jim.
Yeah, it's a big question. So without knowing Jim's personal circumstances, I would say that the first question you want to ask yourself is, do I need this capital in the next 5 years? If the answer is yes, I need it, I'm buying a cottage, I'm buying a car, if you have it earmarked for some sort of purchase, and to be really conservative, I would use a 5-year time horizon. If the answer is yes, I would keep it in cash or cash equivalents, maybe a bond or a GIC. But the fact is, whether you're buying dividend-paying stocks or even more growth-oriented stocks, the best of companies can be negative over the short to medium term. So to really pursue a return, but the probability of not losing money being in your favor, I would have a 5-year time horizon, at a minimum 3 years. So then if the answer is, yes, I need the money, then you're limited to cash and cash equivalents. And the reality of it is that world is not that exciting. I mean, you can go 2, 3, 4, 5 years out on the curve on a bond or a GIC, and you're thinking, you're in a world of about 3% if you're in investment grade or in GIC world. And then the savings accounts are all minuscule. Were the days of getting a good yield, like we had that window where you were actually earning good money, 5% or so on savings accounts and GICs, that's long gone. But really, I would bring it back to, do I need the money or not? And if the answer is you don't need it in the short term, I would look at equities on a diversified basis. If the answer is no, then you are really limited to savings account and you won't be happy with the yield. But the only thing worse than earning a low return is pursuing a higher return and having less money than what you started with when you need the money.
All right, let's try and get a couple more emails in with this one for sure. It's from Porter. Would you be buying Visa at these levels?
Look, we like Visa. It's if you look at the chart, it's had a great run. But when you look at in terms of the business itself and where the valuations lie, we do like the support sort of that you're seeing at these levels, sort of at this 325 range. So I would consider being in here. I would build maybe a half position, Porter, but at Visa as a whole, we like the business. I mean, look, there's no credit risk. You got no credit risk when you're in Visa, 60% operating margins. We still see a lot of growth.
Cash, I got to cut you off there. Sorry, we're out of time, but thank you for joining us. We appreciate it, but we are out of time. Thanks, Cash Pashutin, for joining us today. And he's up next with the markets, with the open, and markets will open a little over 30 minutes from now.